Welcome back to the best prop for you trading floor. Today we are breaking down the Dow Jones after a roller coaster 24 hours. If you are trading a prop challenge with best prop for you, pay attention. We had a massive drop yesterday driven by AI sector fears, but today the CPI report has shifted the landscape. We are seeing a bounce, but is it a trap? And does it change the plan? Trading these transitions obviously is where most traders fail their challenges. So volatility is high and the FOMO to catch the bottom is dangerous. So let's look at the structure so you can trade this with precision rather than emotion. First, yesterday the Dow took a big hit after reaching, of course, record highs for the first time at 50,500 plus. Okay, but as I was just saying, we got also the CPI numbers that came out cooler than expected, following a hot NFP. So what might happen, okay, although it becomes like more of a balanced situation now, a hot NFP versus a cooling CPI, what might be happening though is a repricing of the hawkishness of the Fed following the NFP. Okay, so the June rate cut is still on the table, and this is very important. So now the Dow being a more defensive index than the Nasdaq, it's less volatile. Let's say it's got more chances of stabilizing. Okay, so we aren't seeing the same violent swings as the tech sector. That's the point I'm trying to make here, which makes this a cleaner setup for technical traders. So we had a clear correction, okay, down to 49,000, just shy of the psychological support. When this happens, okay, and we see the Bollinger Bands expanding, typically prices revert to the mean. And this is, of course, supported by the bullish catalyst following the CPI report. So with volume also rising and confirming that is indeed some institutional smart money may be behind that move, there is a high likelihood that we might see that moving all the way up to the 50K. Something else that is important to also note is that this drop to the downside has actually come below the 61.8 Fibonacci retracement, the golden pocket as we say, and it has actually even taken the stops below that low. So that's why I always say, or I always do personally, when I'm using the 61.8 to enter a trade, I'm going to go and put my stop below the 78.6. So you might want to do that too if you are considering to take in that trade. Now, why this matters when we have a rise in volume and a bounce at the 61.8? Because typically this is a more supported, backed by technicals at least, and psychology reasons. So for me, this is a case where today, as the market, of course, is about to close in a few hours anyway, we might see that move extend to the 38.8 Fibonacci, but maybe not go to the 50K. Either case, there is, of course, two paths to this. One is the recovery during the long position, and we see the Bollinger Band, of course, taken out. But then once we get to the 50K, we have two scenarios coming into play once again. One is we're going to see the bottom Bollinger Band start to follow the top, the middle as well. And that would indicate, if there is a slope, that we might break the middle Bollinger Band and go all the way back to new highs. And then once we get there, we see whether this is going to be a double top or not. The other scenario is the scenario where we get a rejection at the middle band if, of course, okay, we do see prices going up there. So a failure at the 50K would confirm that the lower high is in, and we would trade the next leg down. Now, something important to pay attention to. This is the tight range that we saw before the breakout. We actually came down all the way to duplicate that range to the 49K plus. Considering this is an important range to take into account. From the bottom to the current leg that we see extending, this indeed takes us exactly to the Middle Bollinger Band, to the Middle Bollinger Band that actually saw the red candle breaking through, right? So you've got this area, this zone is quite important, okay? And this is what we want to pay attention to. If we see this reverting and we lose the 61.8 Fibonacci, a likely scenario might see us, it depends on the, of course, where we're going to pull back to the 100 Fibonacci extension. So if we go up, you can use the extension level to see where this could take you. And we're looking at the 100 Fibonacci extension in this particular case. These levels are dynamic, so you have to take into consideration this. Now, before you execute, remember the best prop for you rules. We are at the end of the week. Liquidity can get thin and spreads can also widen. If the move to 50K doesn't happen today, do not chase it. If you're long against the 61.8, your stop must be below the local wick at 49K. Okay, and as I said, below the 78.6 as well. This is something that I do. If that breaks, this setup is dead. Now, if you are up already in a trade, it might be a good idea to secure some of your profits as we come into the weekend break. Don't turn a winning week into a losing one just because you wanted to catch the exact top. Passing your challenge is about consistency, not hitting a home run on a Friday afternoon. So watch the support at 49,335 and that 50K overhead resistance. The CPI gave us the bounce. Now the technicals will decide the trend. Stay disciplined, manage your risk, and enjoy your weekend. This is best prop for you. Trade smart.